This is Thunder. When you subscribe, you turn knowledge into money. Most people think business value is something you discover at the end. You build for years, you work late, you take risks, and then one day you find out what it is all worth. That's the lie. Value isn't discovered at the exit, it's engineered long before anyone shows up with a check. Today's guest understands that better than almost anyone operating in the New Zealand middle market. Jeremy Pak is the Managing Director of Velocity Capital New Zealand, a transaction and deal advisory firm focused on one of the most misunderstood parts of the economy. Businesses doing between 5 and 100 million in revenue. Too big to wing it, too small to tolerate mistakes. Jeremy, what are the most common mistakes buyers make when acquiring a business?
Thanks, Andrew. Nice to have a chat with you today. There's plenty of mistakes that I see people making on a fairly frequent basis, and there's a good place to start is comparing multiples between different industries and thinking their business is worth more than what it actually is in the hands of a strategic buyer.
How can buyers avoid overpaying? Buying a business, most people, if they're going to buy a business, it'll be a one and done kind of situation.
Yeah, so there's corporates that habitually acquire. It's part of their strategy to do bolt-on acquisitions and acquire complementary capabilities or geographic areas to fill out their domestic market profile. Avoiding overpaying, doing good due diligence, enhanced due diligence. I think the market's changed quite a lot in the last few years, where sale processes are typically running from what normally would have taken 6 to 9 months to closer to 12 to 18 months, in some cases as much as 2 years. Particularly if you're selling to a private equity platform business, they'll do really enhanced due diligence. And one of the things that's very often overlooked is the cultural aspects and the people due diligence, because ultimately if you're buying a significant business, you want to make sure that cultural alignment is high, that there's good retention of staff and good alignment in terms of incentivization for the senior leadership team going forward.
I would say a common mistake would be thinking this isn't going to take that long, 3 to 6 months. The assumption should be right from the beginning, 6, 9, 12 months or longer.
Yes, very fair comment. I think for larger or mid-market businesses, things do take longer, particularly if you're dealing with overseas buyers who have different stakeholder groups, different internal approval processes. The outreach needs to begin early, and people need to understand that it does take time to drive engagement, to negotiate. There's ultimately a trade-off between how long you want to run the sale process for and value. So if you want to extract maximum value, you want a longer negotiation period that works in your favor, particularly if you're dealing with multiple parties. Because at the point that you sign exclusivity with one party, you're effectively locked in. So very rarely are you able to extract more value to your benefit if you're acting for the seller once you've entered exclusivity. So the longer the negotiation period is more advantageous to the seller. And I think people they gloss over the detail that's required to actually prepare the business for sale. So prepare the data room, prepare the financial data book, make sure that everything is, from a contractual perspective, clean, able to be transferred in terms of indirect and direct changes of control. There's no IP leakage. You may have a really high intellectual property-based business, and in fact, you may have a trade secrets IP strategy. It's not safe to just rely on non-competes and restraint of trades. There needs to be other undertakings in the employment agreements that prevent previously employed staff from taking those trade secrets to a competitor or anyone else for their own personal benefit.
And what about the common man, guy on the street he's been in a corporate job and now he's thinking, I'm going to buy a business. He's looking at businesses for sale, the listings. The most common mistakes those first-time buyers are making.
Deal fever. They rush in without doing adequate diligence. And I think it's a double-edged sword there, because if you've got a business with 500,000 or $1 million profit, and they've got the financial capacity to buy that business, on average, if you're looking at businesses through a business brokerage, for a business that's doing $1 million EBITDA, you'll have 100 confidentiality agreements to wade through as the sale advisor, which means that potentially you could end up with 2 to 4 or even more offers on the table. And when the vendor's considering those multiple offers, they'll prefer a quick, clean deal over someone who's going to do a lot of diligence on the business. So the way to manage that is make sure that you, as the buyer, are actually prepared to do diligence. You can't go on and wing and a prayer with no lawyer waiting in the wings, with no financial accountant or due diligence advisor waiting in the wings. You actually need to have a team assembled and ready and available, so that when you press the button and go into diligence on a business, you've got a team to do the diligence for you. And um, a lot of people misunderstand that and aren't adequately prepared.
I mean, you can easily spend 25 grand in 2 weeks researching a business to buy and then not pull a trigger on it. And I think a lot of people don't take that into account.
That's a fair comment. The challenge that you have is that no business is perfect, and a lot of the older generation who've had these businesses and are in their, let's say, mid-60s, they're sitting on a cash cow that's delivering $1 million, even $2 million or more profit per annum, and they don't necessarily want to change it. And that's reflected in the fact that there are things that can be improved, or even, in fact, need to be improved. And no business is perfect. You'll have a very healthy business that has all the fundamentals right, but there's always things to change, and people look for perfection when things aren't perfect.
Yeah, I describe business ownership as managing non-compliance, managing drama, managing problems. There's no perfection in business, and that as a business owner, you got to be a problem solver. And if you're coming out of a corporate environment, certainly it can seem a bit more structured. You go into business ownership and everything's a mess, and you think, I can just clean this all up. Often cleaning up those problems eats away at all your profits, and then more problems come up anyway.
Yeah, that's a really fair comment. A lot of people really struggle with moving from a corporate employee role into business ownership. And you've hit the nail on the head there. They try and apply corporate disciplines to a really profitable mid-market business, and you run the risk of fundamentally changing the culture. And what you need to do is win over hearts and minds, because the business owner's left, you're the new business owner. People are fundamentally the important part of your business. You want to make sure you keep all your staff, keep your suppliers and customers happy, but it's about people. People make those decisions to leave or stay with the business. Take them on the journey, help them understand the reason why something needs to change, and particularly what's in it for me as an employee. If we change this, this is going to make my life easier by X, Y, Z. Spell it out to them, help them see it, understand it, and practically how it's going to help them day to day.
If you want opinions, there are thousands of channels. If you want understanding, this is one of the few. On Fundit, we don't chase noise, we track what money is actually doing. Subscribe and stop being surprised by the market. Most people consume finance like entertainment. They watch, they forget, they repeat the same mistakes. Fundit is for people who want an edge, not a distraction. If that's you, subscribe. If it isn't, this channel will make you uncomfortable anyway. Jeremy, what are the biggest mistakes business owners are making when they're preparing to sell?
Um, Not having the right advisors around them. And I see it quite frequently in a number of different domains: accountants, lawyers, sometimes bankers. Um, uh, Very broad question.
Yeah, well, certainly you can pick the wrong lawyer and the wrong accountant. It's a very unlikely scenario where your accountant for 10, 20 years is going to be the right accountant to help you sell the business. It's the same with the lawyer, family lawyer, especially. A lot of people go with the same lawyer for a long time. It's a family lawyer, relationship stuff and property transactions. Doesn't mean they know how to do business transactions, right?
Yeah, precisely. So there's a lot of complexity involved, and some of the things are as simple as networking capital. Sometimes it's included, sometimes it's excluded. The difference between sale price, enterprise value, equity value, uh, they're not the same things. Things like earnouts and making sure there's adequate earnout protections, both for the buyer and the seller. There's, I mean, you raise a really good point. It's about whether you've got a specialist who specializes in financial due diligence and preparation for a sale, or if it's just your compliance accountant, if it's your trusts and conveyancing lawyer and not a commercial lawyer, are they the appropriate person to manage the actual process and negotiation of the SPA and so on? One of the other things that I see a lot is the contractual documentation, making sure that those contracts with customers, suppliers, even employees can transfer with the business. Really good example being if you've got a business that employs migrant workers and you're an AEWV, accredited employee, work visas, you need to be able to make sure that you've got all your visa documentation up to date with your employees, that that's all managed appropriately in terms of employment relation obligations. Each part of the commercial law subject matter expertise needs to be looked at.
Jeremy, how are owners misvaluing their businesses? Now, valuation is this mythical thing. What do you think is the best starting point on how to value a business? We'll ignore the 1 million and below revenue businesses. Those are a little bit more difficult, but how do you value a business? What's the starting point?
Great question. So it's as much art as it is science. I get things that come across my desk sometimes where I see people applying a multiple based on SDE rather than EBITDA. I get people that are making just simple formula errors and simple formulas like sum formulas, and even a discounted cash flow analysis came through last week, and very reputable firm. And there were four output ranges in terms of enterprise value, and they'd taken an average of three of the cells rather than four of the cells, and that materially affects the valuation range and conclusions. So first and foremost, most people tend to go for comparable transactions, and that's hard to do in the mid-market because you don't have necessarily depth of transactional volume to identify what the transaction multiples are. Where a good advisor can help you is to actually understand what those multiples look like in different areas geographically, not just New Zealand, and doing discounts from publicly listed back to a private market in terms of liquidity discounts, discounted cash flows. There's always a risk that it's confirmation bias. You can make a spreadsheet tell whatever story you want it to, and a competent advisor will actually give you a fair and balanced view that the counterparty would reach more or less the same conclusions on, and you can have a discussion around discounted cash flows. But discounted cash flows are only used for, I'd argue, a subset of most business sale transactions. The reason being, you need to have contractual certainty and revenue certainty. So if you've got a business with 2, 3, 4, 5 years of contractual revenue, and that rolls over with fairly good tenure and repeated renewals over time, there's a strong argument to use a discounted cash flow. But in most cases, I'd argue not. Comparable transactions are, generally speaking, the better method for valuing.
Yeah, and it's a very, very difficult game to play, especially for new buyers. You can look at the balance sheet, look at the net assets, and then you can look at the EBITDA multiples, and just that alone can confuse the heck out of everyone, and that's not even thinking about the future. No, for businesses, say first time business buyer, business is doing 10 million revenue, 1 mil profit. What do you think is the best way for them to say, how am I going to value this business to make an offer?
You need to have, and generally speaking, you need to have more information than most business brokers would put into an IM. The big four firms do a much better job, and the boutique advisory firms do a much better job as well. You need to have ideally 5 years rather than 3 years. And I say 5 years and potentially even longer because people want to understand what the business is doing pre-COVID, during COVID, post-COVID, with some different macroeconomic conditions running all the way through that. Balance sheet, particularly the net working capital component, so you can calculate what the ongoing net working capital requirement is. If it's a capital intensive business, understanding what the CapEx requirements are, the history of CapEx spend, as well as is there any unmet CapEx requirement that needs to be built in going forward. I see IMs all the time that just have a P&L. You might be lucky if you get a balance sheet, and you might be luckier again if you get net working capital. But generally speaking, when I see them, they'll have a net working capital as at the year end, which doesn't necessarily replicate what the ongoing seasonal net working capital requirement is of the business. It's just as at a point in time, which is a little bit unhelpful for someone who's trying to buy a business. So you need to make some assumptions, and during due diligence, if there needs to be a price adjustment, you front foot that pretty quickly. So you need to identify that, or try and get as much information as you can up front and explain all of that to the sale advisor to make them understand, hey, look, this isn't really sufficient for me to put a value on the business, and here's why. So resetting expectations almost.
There's valuable insights. Thanks, Jeremy. Velocity Capital, and we'll talk again soon.
Great. Thanks, Andrew. Appreciate your time.
The market doesn't reward effort, it rewards clarity. We bring you the thinking behind the moves, not after the headlines, before them. Subscribe to Fund It and start seeing what others miss.